With the new and potentially severe economic crisis looming as a consequence of the pandemic and of the countermeasures, people start talking again about helicopter money. Businesses lose their cash flow, families lose their income, and are in a desperate need of cash. And hence, people look at central banks to do whatever it takes, injecting money in the economy as if they were throwing it from the sky from a helicopter. Now, this image of the helicopter was first used in 1969 by Milton Friedman, not to describe a policy instrument, but to warn against the potential inflationary effects of monetary injections. The helicopter was described as a policy instrument in 2002 by Bernanke, who, after 5 years, became governor of the Fed and was responsible of monetary policy at a moment where he actually had to use massive liquidity injections to stave off the evil effects of the global financial crisis. And thereby he earned the nickname of Helicopter Ben. Now, in the wake of a new crisis, the helicopters are being pulled out again. We saw in the past weeks major central banks promising massive monetary expansions. The ECB, 750 billion euros, the Fed, whatever it takes. And this money, unlike in 2008, is not going to the financial markets or to the banking system. It is being channeled primarily to governments and through the governments to ailing businesses and households. And this, of course, is a good thing because it sustains those businesses and those households, and because it provides a support to the productive sector of the economy as opposed to financial speculation. However, this is also associated with a risk, namely the risk of inflation. In fact, unlike in 2008, we are facing today not just a demand shock, but also a shock on the supply side. And this is a huge difference, even with respect to the situations of war with which the current situation is frequently compared, most recently by Mario Draghi. In fact, in a war, we have what is called the total mobilization of productive factors. Instead, what we witness and indeed experience personally today is the virtually total immobilization of productive activities. Hence, it is not enough simply to throw money on our economic problems. We have to make sure that the money goes where it is most needed to support the production of actual goods, both private and public goods, and that it is maintained in circulation, and eventually that it disappears when its work is done from the sum of a nation's wealth.